Tobias Levkovich with us as we look to the United States and to equities. Can Europe make the U.S. stock market go down?
Sure. I mean, we've seen this a number of times as people worry about contagion effects, particularly in the banking system. The economy itself in Europe probably wouldn't make the stock market go down.
Victor, wander over here, please. I want to look at a hockey stick. Here is a Spanish Lehman Brothers. Up we go, recovery, slow rollover. And I guess to reiterate, Tobias, can we get this emotion in the United States, or are we cushioned and removed?
I think if we're going to get those emotions in the United States, it's going to be more around some of the fiscal issues you were talking about before, the so-called fiscal cliff, combined with the uncertainty around the elections, and that businesses start to withhold some investment. But beyond, separating just, again, Europe alone have economic problems, unlikely because it's only about 10% of the S&P 500 business.
Let's look at this note from Mr. Levkovich. Between the two of us, we saw 72 hours of Stanley Cup hockey this weekend. Given a more mixed sentiment signal and valuation backdrop, earnings trends become more crucial for equity price movement. It seems optimistic to buy into current forecasts. Have you marked down your view, and are you selling here?
Well, we've been telling investors, not really selling, that we thought the market was due 5 to 7% pullback. We've been consistent with that view since the end of March. We got about a 4%, it started back up, and was starting to fall back again. So what we're saying very simply is earnings expectations are too high. Current consensus estimates for the full year up 7-8%. We're up more in the 3 to 4% range for the full year. And everybody's really excited, or got really excited about earnings last week.
Right.
Because we saw so many beats relative to misses, almost an 8-to-1 ratio. And if you mentioned hockey sticks before, you kind of have a hockey stick projection in terms of the blade in the fourth quarter. People looking at 16, 17% type earnings growth don't know what economic environment they're looking for to generate that.
A surveillance hockey expert, Abby Joseph Cohen, at another shop, said corporate behavior is different this time, that there's a newer tone to cash flow persistency. Do you agree that executives have actually changed and that the quality or persistency of cash flows can be different than other slowdowns or muddle-alongs?
Well, I hate that those four words on the street. This time it's different. But I think what companies have gotten more confidence. We did a survey looking at 735 companies.
Oh, I like that.
And they talked about how they had accelerated their capital spending programs from up about 6% back in January to up about 11% for this year. However, I am concerned as we get into the thick of it in the summer, July, August timeframe, and that people are starting to think about sequestration, about the end of the various tax cuts and support programs, and on top of that an election, that there might be some pullback, there might be some deferment, not because of cash flow, because of the uncertainty that's going to be generated.
Let's rip out the script here, folks. I want to continue this. Yes, over 700 companies. What else did you learn in your study?
Well, we learned that if you looked at the companies that were more restrained on capacity expansion, those were the ones that were going to have pricing power. For example, semiconductors were not looking to increase their capital spending this year relative to last year. Equipment orders are down year over year. That's generally good for chip stocks. It's good for their pricing environment going forward. On the other hand, if you looked at areas like materials, particularly metals and mining and chemicals, they were looking to add lots of capacity, and that's generally not good for pricing. So those are the kinds of things we're looking for.
The nuances. Yeah, here's a chart here, folks. It's a clear and present bubble. Okay, bond bubble, everybody's piling into bonds, and yet equities have done better than good out of the bottom. When we talk to bond people, and they say there's a bond bubble or a suggestion of it, would you suggest there could be an equity bubble as well when we see the advancements we've seen?
No, and I would almost distinguish two things that's going on in terms of the individual investors still pouring money into bond funds, and they're not doing so into equity funds. The only place they'll kind of tip their toe in is emerging markets, but domestic or U.S.-oriented equity mutual funds continue to see outflows other than income-oriented or dividend stuff. Number two, if you look at valuation criteria where you kind of normalize earnings on a PE basis, use 10-year rolling average, kind of the way Shiller does, but not exactly. And then look at the 5-year forward of the 10-year yield. In other words, look at the futures contracts to normalize away from financial repression. Markets still look pretty attractive on the equity side. So there is a very clear difference in my mind between fixed income and equities. For the life of me, I don't understand why people are buying U.S. Treasuries.
Let's look at this chart. You've seen this before on the show, Tobias. Slope matters, semi-log. going back forever, corporate profits. These are NEPA profits, I believe. And we ask the economists, when does labor get their portion? Forget about that. Do corporations have a productivity model now where they don't have to give it to labor and instead some of it filters down to shareholders?
There's always been a productivity model in that respect. If you look back in history and look at periods of productive opportunities, corporates always keep it. Maybe they'll give a little bit to pricing, so you and I benefit as consumers, but not necessarily as laborers. However, if you look at the National Federation of Independent Business surveys on hiring intentions, it leads the unemployment rate with high degree of correlation with a 12-month lag, which means we're likely to see labor costs start to impinge and infringe on those margins over the next few years. That's not about a collapse in margins, but some give back.
How many points of financial repression are in the Dow Jones Industrial Average? That goose, that oomph from the Chairman Bernanke.
I think it comes through more in the earnings side, less so through the multiple side. In other words, the goosing that you've got, or the very strong monetary fiscal or policy in order to address and hold down rates, cause capital spending, asset prices go up, things like that, really come through corporates and consumers spending more money because their 201ks have recovered to 401ks again.
Or to 301 at least.
Well, we're not that far away from 1500.
You remember your Newtonian physics?
No, not
Okay,
really.
here's Kashkari writing on this. I brought for you just to harass you. S equals VOT plus 1/2 GT squared. Is mean reversion always right? In 2000, mean reversion suggested the bull market for bonds over. Interest rates couldn't stay low, let alone fall further. Sometimes the physics, gets messed up. What's your physics right now? What are you watching right now?
I continue to watch Citigroup's Economic Surprise Index because that was one of the key signals back in July, August last year that you should have been getting long. And back in February, March, it was telling you kind of worry about things start to slip. If that thing, it always does mean revert, but if that model or index starts to stop its downward trajectory and starts to flatten out and move back up, that would be a very important signal to us in the very near term. Now, I'm also watching sentiment really closely. So on our panic euphoria model, one of our designs, we saw complacency back in March. It's drifted down to neutral. If it starts to drift towards panic again, that would be another signal to step into the markets.
Let's drift towards a lack of confidence. Folks, this is an amazing chart. Too much information. And we speak lightly of this. We speak of Spain or Italy or whatever. Well, there's some real hardship. The public votes in France, they did that over the weekend, out with the bums. And Italy, this is Italian confidence. It looks a lot like the Italian stock market today. Yeah, that's right, William. It looks like the Alps. I mean, it's a metaphor for equities. How much do you link any nation's confidence to equity price performance?
A lot more than people would expect. Now,
That's a break exclusive. Tobias, much more than expected. This is really, really important, isn't it?
Well, I think it is less important for consumer confidence, particularly if you have fiscal policies that are supporting consumption activity. So we've seen a breakdown, for example, in U.S. consumer spending and consumer confidence, a divergence, if you like, between the two lines. You don't see it in discretionary spending, but you see it in broad spending because you've got unemployment checks and food stamps and programs like that to help people through difficult times. On the other hand, if you think of business confidence and you think of higher income confidence, that will be reflected in stock markets. And I do think people are worried about government direction. You can see it even through things like wrong track, right track polls. So it does show up in stock prices, but it shows up in a variety of other places too.
Okay, Tobias, thank you so much. It never gets boring, does it?
No.
It does not get boring. France, the Netherlands, and some of the challenges here down to 131 points. What am I watching? I'm watching the Italian 10-year nowhere near that pre-Monte 7%. But nevertheless, equities slammed in Italy. We are going to go to the Netherlands. We are honored to bring you Svidar van Wijnberg. He will join us, one of the leading economists and academics in the Netherlands, and we will join him here in moments. And then Michael Spencer of Deutsche Bank on China and Europe. Negative 132, surveillance midday.